All right, let's get started. So first of all, we're going to have spreadsheets, but these are going to be simulated spreadsheets. Because if we used actual spreadsheets, people might actually get hurt. And so we've simulated all the spreadsheets. You guys have a little workbook that you can, if you want to take notes, you can. But really, this is designed for you as you're thinking about your business. Obviously, I'm going to be asking questions. I don't expect you to answer them, because they're all very personal to you and what's going on in your business. But you can fill out some of these slides in your workbook with thoughts that you have about your business, so you can kind of then take this home. If you want the actual spreadsheets, I have them and can send them out to you. Just email me and let me know, and we can actually get you the actual templates that you can use to then do your own cash flow. So this is going to be a somewhat interactive presentation. So let's get started. So the first thing, let me tell you a little bit about myself. So I started off in corporate finance for some really, really, really big companies. And I liked doing the numbers, but simply put, being a person in a really big company, you're an interchangeable part. And so the question is, how do you have an impact? And so one of the reasons why I do what I do is I really like working with the small and medium-sized businesses, because what I do for these businesses is transformational and it matters and it's impactful to them. And I like having what I do matter to my clients. The second thing is, having worked for so many companies for so many years, one of the things I realized is I didn't like being an employee anymore. I liked being able to build the business that I always wanted to work for. And so that's partially the reason why I founded Lancaster and Hall. So today's agenda, we're going to talk about cash flow projections. We're going to talk about assessment. So this is the first step before you just jump into a spreadsheet, is understanding the situation and what's going on in the business, so that way the spreadsheet can actually do what you need it to do. Because if we go straight to the spreadsheet and it's going to produce some numbers, is it even going to reflect the real situation? So we want to understand what's going on in the business. The other thing we're going to talk about is methodology. So there's actually more than one way to skin this cat. So what we're going to do today for the practical exercise is create a really, really, really simple business with really, really simple cash flow, so we can actually get through this in the amount of time that we have. For bigger businesses, probably yours will be bigger than what we show here, with some complexity to it. There's going to be more stuff going on. And then when we forecast out further, there's a different methodology entirely that we'll use, using some of your accounting information and actually getting information with your accounting system. So we're not going to be able to get into that today, because that's the advanced class. And we're just starting with the basics. We're going to talk about two scenarios. We're going to do a 4-week cash flow, so assuming you're tight within the month. Here, let's do a quick 4-week cash flow, and then we're going to move to a month-by-month projection, dealing with some scenarios about seasonality or, oh my God, something's wrong with the business. We've all been there, where it's like, oh crap, now what? And so we're going to kind of see, how do you catch that early and try to get in front of it? So to get us in the mood and to kind of introduce the topic and break the ice, we have a quick little video. Let's see if it wants to play.
What if you had purchased Apple stock before the launch of the iPhone? What if you had bought Amazon before it was the only place people shopped? At Hindsight Financial, you don't have to wonder how rich you could have been, because we'll show you. In frustrating detail, our advisors will walk you through every single opportunity you missed. We'll even show you luxury items you could have acquired if you'd only invested before things took off. The trappings of wealth and distinction that could have been yours if you'd just listened to your coworker's tip.
I'm telling you, man, buy Bitcoin.
I don't think so. How do you have this?
Hindsight is not just 20/20. It's also incredibly frustrating. Let us show you how many years earlier you could have retired, how little you'd owe in college loans.
Nothing.
And meet the spouse you could have traded up to. Oh, the life you would have had. It's almost too much. And what's our fee? The very low commission of just 10% of every dollar you would have earned had you invested. It's a small price to pay to see the car you would be driving, to the mansion you'd have built on the island you could have owned. Now, you're probably wondering, will we then help you learn from your mistakes and make investments today that will bring you wealth tomorrow? No, we don't do that. But you will get these hats. Hindsight Financial. Coulda, shoulda, woulda.
Obviously, cash flow is a very stressful thing. You know, it's the lifeblood of your business. When the money's not coming in, the cash isn't there to do what you need to pay the bills, it gets very stressful. So I thought a little bit of humor and kind of lighten it up a little bit would help, so we don't kind of just get into this yucky muck of, oh gosh, now what?
Oh, so you're not rebranding your firm?
No, this is not my firm, no. But this is just kind of like, also getting you guys in the understanding that, you know, the hindsight piece is, well, if I knew that, I would have done things differently. So the real trick to cash flow management is being proactive, not reactive. And so enabling you to see what's going to happen with your business, what's going to happen with your cash flow before it's too late. Because once you send the money out, it's out. You can't bring it back in. You know, so you've invested in stuff, you bought the boat, you bought the house, the money's now out there. Well, crud, the business needed that money for something else. So it's about prioritizing. So some of the things that we can talk about is, you know, getting surprised and then you run on tight on cash. So I thought I had the money, oops, wait, nope, I don't. That happens, right? Don't raise your hands. But we know that you would raise your hand because you may have seen that before. You've pulled money out of the business, you paid yourself, and then you find out, wait a minute, the next month I have to put all this money back in the business. That's never happened to any of us, right? And then signing up for expenses that the business can't afford. You hired somebody, oops, can't afford that person. You went out, you bought a bunch of equipment, spent money, but didn't really have it. The other thing that you can happen is asking for a line of credit, visiting the bank, hey, I need a loan, I need a line of credit, but that money was needed last month, you're too late. You're already behind the 8 ball. And then just the stress and the fear and the concern of just being a business owner and being always on this knife edge. It's not fun. So let's talk about cash flow projections. So the first thing we would do is talk about the time frame. How tight are you with cash? Are you getting tight within the month? So you're running out of cash in the next 4 weeks, and this happens every month where you run out of cash in the middle of the month. Or maybe it's, well, I have cash this month, but I know I got some big bills coming next month. So we can look out 8 weeks. Or are we looking to grow the business? And so we're taking cash that we have and we're investing it, but the business needs to grow and it needs to do that within the next 3-4 months or we're gonna have a problem. Or are we looking further out and we're talking about what does cash look like 2 quarters from now at the end of the year? Am I gonna have cash? Am I gonna need to pay taxes? And what is my cash flow going to look like next year? So time frame is the first thing that we want to understand because that's going to determine how far out, it's going to determine the methodology we use, and it's going to determine the amount of detail we put into the cash flow. The other thing we want to kind of talk about is the root causes of your cash flow situation. What's going on? What's causing it? Is your business seasonal? Some businesses run slow in the summer. Some businesses run slow in the winter. Do you have a slow time of year that we want to work through. So maybe you're a seasonal product or there's like a seasonal buying pattern. The other thing is economic. Is there something going on microeconomic, which would be competition? You have a lot of competitors that are like, hey, I can do what you do, and a bunch of competitors show up all of a sudden. Or is it something going on right now in the macroeconomy? Inflation, we're all feeling that. Everything costs more right now. Interest rates, oh my gosh. If you go get a loan, it's a lot more than it was a couple years ago. Or maybe it's not even your competitors, it could be your customers. Something is, you serve an industry and that industry got hit by the pandemic. So maybe you were servicing restaurants and restaurants and hospitality got hit during the pandemic. So when your customers suffered, well, now you suffer because they're gonna say, well, do we really need you right now? Because we've got more pressing issues. Growth. Growth is a frequent cause of cash flow problems. So you've decided to invest in a new product. You've decided that you're going to go hire some folks and invest in some salespeople. You're going to spend some time on marketing and put some of your effort there. And so you're going to go put cash out into the world, hoping that that cash will come back with more customers and more business. But in that time frame of when you put the cash out there and when the cash shows up, there's going to be a little bit of a dip. Could be a problem. And the faster you grow, the faster you burn through your cash. Could be an operational issue. So something is going on in the execution of your business. You changed out a vendor, the new vendor isn't as effective or costs more money. You're getting this margin squeeze, so the cost of your materials is going up. We talked about building products when we were networking earlier. The cost of building products is going up. Or maybe you're having an execution issue in your sales department. They're not converting like they used to. So something could be going on. So what are you doing today? So today, typically, you're going to keep 4 numbers at the top of your head. And that's how you do the cash flow today, I would imagine. Is, okay, well, how much money do I have in the bank account? What bills do I have to pay for the rest of the month? How much money do I think is coming in for the rest of the month? And, oh yeah, I have to make payroll. So these 4 numbers are kind of rolling around your head, and you just kind of napkin math it in your head, and that works. And I suspect that that's what a lot of us do, is we just focus on these 4 numbers, and they are what they are. And as long as everything balances, we're great. And when, oh goodness, we have to pay out more money than what we have coming in and what we have in the bank, oh, we got a problem. And then if we can't make payroll, oh boy, we have a problem. So I suspect, please don't raise your hands, but many of you kind of have done this, where this is kind of the mental gymnastics that you've done. So what we want to do is to give you a methodology that you can use to actually try to get in front of this versus being like, okay, here's the 4 numbers. Am I going to have enough cash this month? Because you want to be able to see the problem and then make changes in your business before you have the problem.
Todd, how many months or years of data do you have to be able to forecast? Like if you have a startup business that's just in their first year, is that enough data?
Yeah, you can do this with a brand new business. What we're going to teach you today is called the direct cash flow methodology, which is just very simple. Here's the checks going out, here's the checks coming in. And it's, these are the deposits to the bank account, these are the withdrawals from the bank account. So we call them here sources and uses. Sources of cash is money is being deposited into your bank account. A use of cash is money coming out of your bank account. For those of us that are more in the accounting realm, we think of it by these columns. Cash flows from operations, cash flows from investments, cash flow from financing. Today we're going to focus on the direct method because it's really simple and easy to figure out. You don't need an accounting system. You can just be like, here's the checks coming in, here's the checks going out. If you have an accounting system and you have an accountant, we would actually project your cash flow using the indirect method as we go further out. So if we're doing a short-term 4-week, 10-week, 13-week cash flow, we probably would go direct method because we can count specific checks. But if we were going to go, show me my cash flow for the next 6 months, show me my cash flow for the next 12 months, show me my cash flow into next year. Okay, we're going to probably switch you to the indirect method where we're taking the accounting system and we're thinking about how much cash flow does the operations of the business generate, cash flow from your investment activity in the business, and cash flow from the way you finance the business. And we separate it that way. I don't think I've ever seen anyone organize it this way into the 6-box chart as to the way to think about it. So if I was going to ask you guys, what's a source of operational cash flow for your business, what would you say?
Client deliverables?
A client deliverable is you producing something for the client?
I think so.
Okay.
Recurring revenue.
Yeah, so sending in, it's actually, it's a little further down the path than that. It's actually getting the money from the client. It's the deposit, because we're talking cash flow. We're not talking like revenue recognition or accounting. This is pure cash. So it's getting the money, the client, to cut you a check that you then deposit. And so customer receipts is actually, swiping that credit card. That's a good source of cash.
You're talking accounts receivable, money in hand.
Well, no. Accounts receivable is an accounting thing. It's when you send an invoice to the customer, but that doesn't put cash.
So you're talking check, cash, direct transfer.
So this is cash is king.
Any kind of transaction that comes into your.
Yeah, this is on your bank statement. This is hitting your bank account. Somebody put money in the bank account. So I can send invoices and I can bill you for today's, but there will be a cost for today's presentation. I'll send you all an invoice. But that's not going to put cash in my wallet. What puts cash in my bank account is when you write a check and I deposit it in my bank account. Or when you, and it clears. We know you're good for the money. And so, or when I swipe that credit card and then the money gets deposited by the bank into that bank account after you swipe those credit cards. So it's actually the actual cash transaction. So we think about the operations of your business. How do you use cash in your business?
Pay for stuff.
Payments to vendors. Yeah, you get bills. The bills themselves don't eat up the cash, but when you have to pay that bill, okay, that takes money out of your bank account.
Payroll.
And feel free on your little worksheets. You have this worksheet. If there's something specific about your business that you want to write down, because ultimately this is what then builds the next spreadsheet.
Chad nailed it. He said payroll.
Payroll. And credit card charges, right? You got to pay that. You can swipe the credit card and pay all your bills on that credit card, but eventually you got to pay the credit card.
Sales tax.
Yeah.
Yep, sales tax.
That's for it's not free money.
That's for a bigger limit.
No, the credit card is not free money. The bank's actually expecting you to pay that back at some point.
Usually, isn't a 3% fee usually though? Is that what we're talking about?
It depends on the.
No, in this case, so you have credit cards in two places, right? You can use a credit card to collect money from your customer. So typically there's a merchant fee and a cost associated with that. And then you can pay a bill using a credit card. Historically, that isn't passed to you, but I know that that's been changing a lot as businesses have been getting squeezed. Oh, you're not paying by cash. There's a 3% charge to use your credit card to pay this bill. We're starting to see that. I know the credit card companies were fighting that a long time, but yeah. So then investments. So when I say investments, this isn't Apple, Google, Amazon. We're talking about you investing in your own company through capital equipment. So if you think about a source of cash from investing in your business, anyone have an idea of what that might be?
A Nerdmobile.
It would be selling the Nerdmobile. So how do you get cash out of the business from making an investment? You have to sell the fixed asset.
Yes, or Ubering the Nerdmobile.
So if you have like a piece of equipment or a vehicle or a building, and you decide to sell it, that actually generates cash flow for your business. It's not related to the operations because it's not your day-to-day, but it's really your
An emergency parachute?
Yeah, that sounds like a last resort.
well, it sounds like if you're going to downsize the business, or it's like, well, we needed a bigger building, so we have to sell the old one. We bought a bigger truck, or
Some companies do that and do a lease back, and then they grow and buy the next building. That's how they grow the business,
yeah.
the number of locations.
So just understand that your fixed assets can be a sort. We're not asking you to yard sale your business, but as a part of doing business, you can sell some of the infrastructure of the business to generate cash, but we put that in the accounting system in a different spot. That's why it's in a different column. And so the opposite of that is a capital expenditure. So you buy equipment for your business, you buy a vehicle, you buy a building, and then, oops, that just showed up. Okay, so financing is how does the business, it's not related to the operations or the investment. This is how does the business generate working capital for itself outside of operations and investments. So you could go to the bank and say, I need a line of credit, I need a loan. Another way, talked about if you're a small startup, maybe you get an equity investment. You get an investor to put money in the business. That's a source of cash for the business. It's just this third flavor.
Shark Tank.
Shark Tank.
Limited partners.
Yep.
Transfer money from my personal bank account to hit payroll.
So, but this financing can also be a use of cash. So you decide to pay off a loan. That could totally be a use of cash. Is, hey, we have this loan, we have this line of credit, we don't want it anymore, let's pay it off. Or we have this investor and we don't want that investor anymore. That investor wants to do their own thing. And so we're going to take their shares in the business and we're going to buy them out. So that's very different from the operations and from the investing. I'll hold it here so you can grab a picture if you want.
Would an ESOP be considered that?
ESOP is kind of in two places because you're compensating your folks. So there is a business expense. So you think of like ESOP or restricted shares or phantom stock. That's an operational cost, but then you also have to have the buyback on the other side. So it's actually in two places. We're trying to keep this simple, Alan. It's like, what about a convertible note? And
Well, when I think of an ESOP, I think that is an owner trying to exit, so they're pulling cash out of the business.
yeah, but if you're thinking about like for an owner, yes, that would be a financing move. Whereas the owner getting paid on salary is really like an operational move. All right, so now you guys have this template. And again, this is designed for you to take notes and to kind of fill it out as it makes sense for your business. In this situation, I've got 4 weeks. Could be a month, could be this month, could be next month. Week 1, week 2, week 3, week 4 of a month. So let's talk about how does this spreadsheet work. So you have a checking account and you have a credit card account. A lot of us have credit cards for our businesses. And then you have these sources of cash, uses of cash, and then you get the weeks and the columns. So the first thing we're going to do is simplify the situation. We're going to take out the credit card. Because the reality is the credit card doesn't generate cash flow for your business. It's basically a opposite type of bank account. And so if you want to actually forecast your balances on the credit card, we can do that. That's just going to overly complicate it. And the reality is most businesses either fall into one of two buckets. You either pay off your credit card every single month. So whatever the credit card bill is, we pay it. And so what you'll find is that it's roughly the same number every single month and it doesn't really produce cash or reduce cash. Or you hold it at a certain level and again, it doesn't really generate cash or reduce cash. the credit card only becomes a source of capital or use of capital when you're running it all the way up or you're paying it all the way down. And if you're not going to do that, we're just overcomplicating the spreadsheet. So we're going to take out the credit card and really make it simple for you. All right, so then what we're going to do, now that the credit card's gone, oh, this is so much simpler, is we're going to start with week 1. Here's your beginning balance. So the way to look at this, the first 4 rows is you got a beginning balance at the start of the week or the period, because this could be months or days or quarters. We're doing weeks here because we're assuming you have a short-term cash crunch. So here's your beginning balance of the week. Then you're going to list your sources, total them, and that goes in as a positive number under sources. And then you're going to total up your uses. That goes as a negative number, and then you sum beginning balance plus your sources minus your uses. That's how much cash you're going to have at the end of the week. And then you carry the number to ending balance of the prior week, beginning balance of the following week, and then that's basically how this works. So this is just a simulated spreadsheet. There are no real formulas here, but if you were going to do this, or if I send you the template, that's basically what the formulas do. So first, we're going to get tight on cash this month. So the first thing we're going to do is we're going to populate our sources. And so we're actually going to put in, okay, we've got credit card receipts, $2,000 a week comes in. Got a couple of customer invoices that are going to be coming in. Remember, this is when it's when they write the check and you deposit it and it clears the bank. So there's a timing issue here. Sending them an invoice that they take 2 months to pay, you don't see that cash for 2 months. So just remember that we're doing this on the cash basis. So it's when the deposit clears the bank. That's what matters. And because we're trying to predict, how much money is going to be in your bank account at the end of every week is what we're trying to figure out. Then what we're going to do is we're going to detail out this a little more. Because for invoices, we want to see specific customers because these are big checks that are going to come in. So we're going to detail those out. So we have customer A. We expect them to pay their bill on week 2. Customer B, we're going to deposit their check on week 3. Everyone's following so far? Any questions so far? Okay, then we're going to go put in some of the uses of cash. Mention payroll, maybe you pay yourself, imagine that. Maybe some taxes. And you can see now that you've got a business that twice a month, week 2, week 4, you got to go spend $16,000, and now you can see the $16,000 populates as their total uses on those weeks, and now you can see that it's actually calculating. So week 1, we started with $1,000, $2,000 comes in. We end that week with $3,000, carry to the next week. $22,000 comes in on week 2. We spend $16,000, so we'll end the week with $9,000, and so forth. Everybody's, okay.
Is the tax, is that a reserve account where you're just kind of accruing for an annual?
No, I'm assuming that's like your payroll tax.
Okay.
It could be. Now, if you're going to do a reserve, remember, this is cash only. So if you were going to do taxes, we would be way out here when you're going to write that tax check, your estimated tax check. So, we pay estimated taxes 4 times a year. Okay, here's the January 15th payment. And you're going to put that on the calendar when you're writing the check, when you need the money to clear the bank. So, reserves, totally different situation. That's you planning ahead and holding back money in the anticipation of needing it in the future. But if you see that you're going to have a big tax bill, you can then build up your cash balance. So your reserves are actually up here in the account itself, assuming you don't have a money market account on the side to hold your reserves. Okay, so we're going to further detail out our uses of cash. So maybe we've got some vendors. We've got 2 contractors. We pay them the first week of the month, $3,000 a piece. And we have some software, and that bill comes, for all that software once a month, typically on the first of the month. And now you can see we may have a problem. Does anyone see the problem?
Timing.
The timing is a problem. We started the month with $1,000, and at the end of week 4, we ended with $2,000, but we're having a problem getting through the month because we have a negative $7,000 in the bank account at the end of week 1 and a negative $1,000 in the bank account in week 2. That's an overdraft. We don't want overdrafts. That's bad. That means that the bank may bounce a check, or it may cover it, but then it's going to be like, because you borrowed money that really wasn't your money. And so the whole game is get rid of the red in that ending balance row. We don't want that. So, okay, let's think about this. Luckily, we're planning ahead this coming month. How is it going to work? And we said, okay, well, maybe what we do is we call customer A and we negotiate with them and we get them to pay their bill on week 1. And maybe we talk to contractor A, and instead of paying them on the first week, we say, hey, we have 15-day terms with you. We're going to pay you 15 days. And we can move them out 2 weeks. So we're going to make these 2 moves, do it in a spreadsheet. And then all of a sudden, you can see that now the ending balances through the month work. We don't have any negative balances during the month because we're ending week 1 with 16,000, ending week 2 with 2,000, week 3, 16,000, week 4, 2,000. So we're actually now have a cash flow that works. I can send you guys these slides if they help. You don't have to take every picture. It's okay. All right.
So how do you get that customer to pay early? Do you have to offer a better rate? Like if you pay early, we'll take some.
Well, first of all, it starts with the contract. How do you write your contracts? Do your contracts tell your customers when the bill is due? And then do you call them? You actually train your customers. So if you call your customer or send them an email, hey, 5 days, this bill is due in 5 days, just letting you know the bill is due in 5 days. And then the bill's late. Hey, the bill is late. And so if you keep that, if you train your bookkeepers and your accountants when they communicate with those customers to really let them know that the bill's coming up, let them know, hey, there's an expectation here that the contract says you pay on this day, you pay on that day. And then, because ultimately what ends up happening is if you don't have good discipline around collecting money from your customers, what ends up happening is they're like, oh, source of cash. Your customers can literally borrow money from their vendors by just taking longer to pay them. You're literally money in your pocket versus money in my pocket, and you're playing this little timing game, and you're effectively borrowing money. It's called trade receivables. And so managing that, having a good contract, and then having good processes in the business, you can train the customers. You don't have to negotiate anything to get them to pay. If it's in your contract. No, there are state regulations about what you can charge for a late fee and what's appropriate. But again, it's in your contract, but it's your responsibility to train the customer that you're enforcing your contract. So if you only call them once in a while when they're 3 months late, that training didn't work. When you're talking to them every single month about, hey, email reminder, bill's coming up, your payment is due in 5 days.
If you're calling them every 3 months, then you did train them to pay every 3 months.
Yeah, it's like negative training.
Right, negative.
So it's really building that habit with your customers. Now you can do things like early pay discounts. Hey, we'll give you 1% off if you pay 3 in 1 week versus 4. You can do that, but ultimately most businesses, are built on, the customer-vendor relationship is built on trust. And so it's about building the trust, building the communication, and being able to say, hey, you agreed that you would pay on this day. You're going to pay on that day because we have a relationship and we have to trust each other. So you don't actually have to give anything up to get paid. If you have to give something up to get paid, there's something going on. All right, any questions here? Other questions? Okay. So, okay, this never happens. Surprise, something happened. Something that we didn't anticipate happened. What we're going to do is we're going to say customer A decides to delay their payment. They were supposed to pay on week 1, but instead they decide they're going to pay you next month instead. They're going to take that payment, push it all the way out. So this kind of speaks to what we're talking about, is having that conversation with your customers, setting that expectation. Yeah, if you don't communicate, you didn't tell me I couldn't do that. But let's be proactive. You know that some of your customers are going to be like that. So maybe what we need to do is not run the business so tight and build up a little bit of working capital in the business. So that when a customer does this, because they're not going to tell you they're going to do it, they're just going to do it. They're going to ask for forgiveness, they're not going to ask for permission, but can you anticipate them doing this? And then what can you do is, we're going to call our bank ahead of time, and we're going to know that we need a line of credit to build up enough working capital in the business, so if a customer were to do this, there's still enough cash to cover. So that way you have that line of credit that customer didn't pay the bill. Okay, I'm going to pull on my line of credit now. And so here we're saying loan, line of credit, but the idea is that we're not going to run the balances so tight. We're going to lift the business up so that way now you see that you have a source of cash called take a loan out from the bank. Obviously, you can't do that when it happens. You have to anticipate and be proactive and say, okay, what do I need to have in place so if my largest customer pays their invoice late, I'm covered. It's not something we want to train them to do, but it's something we want to be prepared for so that way if they do it, the business is fine. And so you can see we do that.
So Todd, maybe this is a question for Joe, but is it a line of credit or is it a loan? Like, can you draw from it as needed, or is it always accruing interest? Like you're always going to pay?
Line of credit it won't accrue interest unless you pull from it. So it kind of works like a credit card without the card, where you can move money back and forth.
So that's what you're talking about here is a line of credit.
Could be a line of credit, could be a loan.
Could be a loan. I mean, other people do just a term loan, like they have a bigger expense coming through. But if you're using it for operating capital, typically what I see is a line of credit. Because once he gets that $20,000 next month, he's going to pay it back. So he's not paying that interest.
Another surprise.
There could be another surprise.
Early
Kind of
in the
move
year.
through.
So you're not paying interest on cash just sitting there.
Right.
Okay. So that's kind of an example of kind of helping yourself get through the month. Any questions? Kind of straightforward, maybe. Call me if you need some help. Okay, so then what about month to month? So now we're going to talk about, we've got a planned expense coming up. We're going to do something with the business. We're going to go further out. So instead of looking at week 1, week 2, week 3, week 4, we're going to go out a few months, June, July, August, September. And the rest of the exercise is the same, except for now you're not thinking week to week, you're thinking month to month. So this is actually the same company. We're just taking the 4 weeks, summing them up, 4 weeks, 4 weeks, 4 weeks. So now we have a business that brings in $43,000 of cash comes in every single month, and $37,000 of cash goes out every single month. It's the same two customers, 2 contractors, some software, same setup. It's just, we're just changing the columns on you. So looks like a great business, but now we have seasonality. So let's say this is one of those businesses that gets slow during the summer. It's a good business, works out across all 12 months of the year, but we have better months, and then in the summer it does this little dip. So what we're going to do is we say, okay, so we bring in $43,000 in June, but then July, August, September, only $24,000 comes in. that can very quickly throw a business. So there's lots of businesses that are like this, where they have good months and then they hit their slow time of the year, and then that puts them into a cash crunch. And then we know that in October, though, they'll be back at $43,000 coming in every month. And so they just have to make it through these 3 months. Again, a simple example, but you can see that their bank account in June ended with $7,000, then they go down to $6,000, down to $19,000, $32,000 in the hole. So, you know, now they may pop out the other side, but how the hell are they going to get to the other side and make it through those 3 months? So Joe mentioned, hey, line of credit. Yeah, we could totally do a $25,000 line of credit, and then maybe not run, and then we'll make some adjustments maybe on the expense side. We know that the summer's going to be slow, so we let one of our contractors go for 3 months. Because we can get in front of it, we know how the business is going to work, we know that the summer's going to be slow, we know we don't need 2 contractors through the summer, we only need 1. We can ratchet the business down. And all of a sudden, look, the business now can make it. It's running tight by September, so it better bounce back in October. But if October looks like June, it can pay back that line of credit. Okay, so now let's put another twist. It's the summer, but you ain't bouncing back. It's a slide. It's not seasonality. There's something operationally changing or economically changing with the business. So what you have in here is what we thought was going to be 24,000, what did we say here? Yeah, 24,000 a month is really now 24 going to 18 going to 17. We're on a slide. Will we come back in October? And so what you would do here is your CFO would say, okay, we want you to have some leading indicators. You have metrics, you're tracking your sales pipeline. So you're tracking your sales conversions. There's things earlier in the business that's telling you your sales pipeline doesn't look like what it did this time a year ago. Things are changing. Get ready, it's going to storm. So now we're going to get in front of it. So we have leading indicators in the business that tell us a storm is coming. And something's wrong, and we can fix it, but we need time and we have to survive the storm. And so what we're going to do is start making some changes in the business where maybe what we do is not only have we gotten rid of contractor 1 for the summer, we're going to dial back contractor 2. And maybe borrowing money from the bank when you don't have the ability to pay it back is a bad idea. So we're not going to borrow the $25,000. We have 2 trucks, but if the business is dialing back, we don't need 2 trucks. We can sell one of those trucks. And so you see in July, we let's say it's a piece of equipment, we sell one of those trucks. And so, because we're going to ratchet the business down. But the difference is we're not doing it in a panic. We have the leading indicators telling us it's a business cycle or there's something operationally going on in the business. We need time to fix it. The business needs to dial itself back because you can't be spending back here. You can't in September have $17,000 coming in, $18,000 coming in August, but you're burning $34,000 a month. It's not a safe place to be. You have to ratchet it down, but the only way to do it successfully is to know that the storm is coming and to get in front of it. So you have time to dial back the payroll. As a business owner, not pull so much money out of the business. And you can see here we're making changes. Maybe we don't need all this software. We can cancel some software subscriptions. And so you can kind of get in front of the storm a little bit so that way when you get down to it, we now have right-sized this business where we're bringing in 21,700 a month. I'm sorry, we're bringing in 18,000, 17,000, but the business now is only cost spending 16,800. The business is now right-sized. So that, but the only way to have done that successfully was to know that the storm was coming, and the way that you know the storm is coming is through these leading indicators, looking at other parts of your business saying, oh, the sales pipeline is not looking as healthy. And understanding how your business works enough to say, okay, it's going to ratchet down. We better ratchet it down. Any questions here?
How does this work for a startup?
So startups are a totally different bucket because they're not a going concern. Startups typically are on their way to going out of business. And so for a startup, typically they raise capital. There's a bucket of money, even if it's just friends and family. And then they assume that no more money's coming in if they can't sell. So startups always look like this. They look like they're going off the cliff every single day. When you do, and so the startup game is how many months of cash do we have left, and what milestones do we have to hit to either avoid this fate or be in a position where we've hit milestones that we can then go back to investors and raise capital again, or say, that is not enough runway. We need 6 months of runway. We need 12 months of runway, and dial down those expenses. I've seen a lot of startups that have a lot of faith in their sales and marketing engine that they've never operated. I'm saying that as nicely as possible. You have a sales process, you have a marketing process, you build the product, and you assume that when that product is built and you've hit MVP, we're going to click on the sales process, we're going to click on the marketing process, then everything's going to work. What if it doesn't? So my experience with startups has been, the first time you turn on that sales engine, the first time you turn on that marketing engine, it's not going to work. So you better be ready to ride it out for a full year with sales and marketing not functioning correctly. I've seen many startups take 18 months, 2 years, 3 years, 4 years to actually get traction on their sales and on their marketing. It's this product market team fit. And that doesn't come together in 6 months. So if you're in a startup, 18 months of runway.
So forecasting works better for somebody who has a track record then?
No, forecasting works great for startups because startups can run budgets. They can tell you what their expenses are going to be. They kind of can sit down and they know, oh, we need these many software engineers. We're going to have these many salespeople. Here's what they cost. Here's the payroll taxes. They can build this spreadsheet. It's going to flow like this. It's going to look like we're running out of money.
Well, I think too, like with the startup, it's really important to still do all of this as you're a startup, because there is going to be trial and error. And like you were saying, it's going to be a matter of time, you know, that first 12, 18, 24 months. But if you don't have this data to back it up and to really, then you're not going to be able to get ahead of it. And it's more going to be, you know, it's more going to be at the tail end of the situation.
I would say that if you're a startup, it's even more important that you do this. Because remember, as a going concern, you just, oh, how much money do I have coming in? How much money do I have going out? What's the payroll? What's the bank balance? Startups do not have money coming in, or if they do, it's never enough. Their business plan says we're going to sell our way out of this problem. As business owners, we've all been there and tried to sell our way out of a problem. You have a good business, you have a going concern. They have a startup. That is a business that's never actually functioned before. So if it's hard for you, it has to be much, much harder for them. And so it's very, very important for the startups to do this so they know what is the zero cash day. on what day is there no money? What's the first day that there's no money in that bank account? What's the first payroll that we can't make? Is that
to like after trying one thing for a certain period of time, this formula I think would help you know when it's time to throw in the towel for that business model and when to say, okay, now I need to really start thinking about this next business model. I have 30 days to do that, to figure out what that's going to be, and then implement the pivot.
And so startups are eternal optimists, right? They're always, they think they can sell the way out every single time. These visionaries of these startups hate this stuff. They hate looking at the numbers. I always say they need an adult in the room, right? They need someone like Todd, the adult in the room, to say, hey, let's game this out. If things go really, really well, what's it look like? If things go really, really poorly, what does it look like? And let's create 3 scenarios in between so we can adjust as we need. They need that because they're so determined on this idea that they have to bring it to life, and they need an adult to ground them a little bit and say, this is real world, like this is your first efforts probably aren't going to work.
They fixate on upside potential and not anything real.
And I feel like it does take, because I know for me, it's taken, like I was talking with you guys about the group sessions with job seekers. That, in this theory, if the sales were to be there, works better because it's a larger group, right? But then in reality, when you go and you actually test it out and try it out, it doesn't work. You know what I mean? So then you have to kind of make that pivot and figure out what that looks like. And I think that's just takes time. Just takes time to go through it.
Yeah. And you put a lot of weight on your forecast too, so that's usually optimistic when salespeople are talking about their pipeline, so.
Yeah, but you can actually measure that. Like some salespeople are like this with the forecast. I don't want to show you my pipeline. You may steal my magic stuff. But the reality is we know that you got to look at the pipeline. How are things moving through the pipeline? What's in the pipeline? What's the velocity of the pipeline? What's garbage in the pipeline? Are they cleaning out their pipeline? But if you're working with a business, and I've done this, and twice a month you're going in there and you're reviewing their pipeline and how things move in their pipeline and shift out, and I thought this deal was going to close in May. It's probably now going to close in June, and June becomes July. And you start seeing that in their pipeline, you can actually put metrics to it and take a pipeline and then say, okay, good, as Amanda said, you can do as Nick said, you can do a good, better, best, or, here's the likely scenario, here's a great scenario, here's a not so good scenario, and you can model it out for them.
And it was touched earlier, leading indicators are so powerful in that sales funnel, in that sales cycle, and you can get really good at predicting when you have enough data and you have an open mind with realistic expectations, and when you're managing those leading indicators, and if something is off track, you're working together to get it back on track. These forecasts, even for startups, can be really accurate.
All right, so let's talk about the benefits of doing this. So it's basically know when you can afford to hire, know when you can afford to add expense to the business, have the right amount of money on hand for future payrolls and expenses, know when you can take cash out of that business and put it in your retirement account, know when and how much cash you can, asking for money before you need it. Getting the money from investors or from loans or a line of credit before you actually need it. And then just de-stressing because you know that the business is going to be okay and it's going to make it. That's really important. So any other questions?
Should you loan to startups? Or do you
We
want to see
do,
a
it kind of depends, but again, we're looking at that same forecast, right? Kind of say, where is that day zero cash? What have you done before? What's your cash flow look like? What kind of assets are on hand? All of that kind of plays factors into it. So typically, I usually tell most startups it's 2 years to get that bank loan. That's just a common number. Doesn't mean that it doesn't happen and we can't do stuff. It's usually 2 years we want to see that positive, right? As Todd said earlier, here's the lump sum of money, no money's coming in, and I'm doing all this marketing expenses and everything. Oh, there's my first sale, right? And what happens?
You always want a
And
personal
you're wanting to see
guarantee.
deposits too.
We're wanting to see that money come in.
You want a personal guarantee, right? You want
Personal guarantee
some sort of asset
everything
like
like
that.
that.
Collateral, yeah.
Well, I think 2 years too it's a good amount of time to have that vision, to be that, passionate about it and be gung ho, really get into it, see what works and what doesn't, and then pivot, have a chance to do the pivot, see how that goes too. So that way, by the time you get to that
Good
point.
indicator, but keeping an eye on those KPIs really matter, because like Todd said, that second bullet point at the last slide, right? Best time to borrow money from the bank is when you don't need it, right? Because a lot of times what I get as a business owner or whatever, it went red. And the bank's not lending you when you're red. Unless you got unless you got big financials somewhere else that we can lean
A lot of
against.
those nerd mobiles.
We want to see black. You need to have that app that is black.
So John, are you thinking about doing a startup thing? Like startup questions?
No, I'm just curious, because forecasting is notoriously opaque. I mean, you rely on salespeople who are either optimistic or they're sandbagging.
Yeah, the whole trick to forecasting is the iterative process.
Yeah.
Because if you're doing the forecast, we're reviewing your sales pipeline twice a month, and we're forecasting you every single month, that causes you to build the discipline, and it's this butterfly effect, where...
This is a sales engine that's not been turned on yet, so at some point you're talking about forecasting once they've got some track record.
Yeah, but you can plant some flags in the ground. If you have prior startup experience, that you're not making your first sale. The experienced entrepreneurs who've done startups know you start selling and marketing before the product is ready.
Doing it day one, customer discovery, planting those seeds. Right?
You're selling vaporware. And it's not something anybody wants to talk about, but it's like these AIs, they're really a bunch of folks that are sitting in a call center chatting with you until they can build the AI because they needed the revenue to come in to do that technology. So it's kind of, there's this selling the vaporware because you have to. Because if you can't sell it, why are you building it? A lot of startup folks have this build it and they will come mentality. Doesn't work. And if you have experience, you know that getting that product market fit, the messaging, the story brand, the sales techniques, getting that all built takes a year to say, get it.
It takes a year to try it and see.
It takes a while, so you better have some money in the bank account and you better not be spending it that quickly because you're going to need that cash to last you during this figure it out phase because there's a lot of and if you're a business owner, you're never not figuring it out because once you figure this out, well, this broke. Now I got to go figure this out. Then I got to go figure this out. Yeah, and then COVID hits. So anyways, this is kind of what I do. We focus on businesses that are trying to balance their cash flow with their growth. We also help with budgets and forecasts. And if you are a startup and you want to raise capital, we offer that too to help you build out your budgets and forecasts. Realistically saying, okay, best case scenario, okay, if things don't work, this is the other scenario. We can help build that out for you. We showed you today the direct cash flow method. We didn't get into the indirect cash flow method. The purpose today was to give you some tools that you could take, but if you feel your time is better served otherwise and you want that done for you, give me a call. Thank you.